It's with great pleasure to have you guys on tonight. We have with us tonight Sam Frower, our lead sponsor on this deal of Compass Capital, and my brother-in-law in Austin, Texas, Rick Schertz from Freebird Capital Investments. Rick and I have been on quite a journey here, partnering up with a shared commitment to find and identify high-quality real estate deals to invest in. And when we encounter one that truly stands out and that we are excited about and to be a part of, then we are eager, obviously, to bring it to you, to your attention as well. So we're really excited about this offering. So I want to be brief. We want to keep this moving. So we're looking forward to diving into the details.
Yeah, and I'll just jump in before we hand it over to Sam. When Brent and I have been looking for opportunities, we're looking really in kind of two broad categories. One is strong operators, experienced operators, and the other is obviously strong opportunities. And really, you got to have a strong opportunity, but inexperienced operators can mess up a good opportunity. So first thing we look at is who are the people pulling this deal together? Who are some of the lead sponsors? So Sam, I don't know if you want to go ahead and pull the presentation up, because I want to walk through some of those names and then tell you just briefly about what caught our attention. And then we're going to let Sam go through the details of the presentation itself so you guys can learn a bit about this deal. But go to that slide, Sam, that has four of the operators on there, if you would. So the first is Sam Frower, who's on the call. Sam's been a part of over $500 million of multifamily transactions. Max Melman is not only one of the deal sponsors, but he's the person who will be signing the note or qualified to sign the note on that. And he has been a partner in over 9,000 units. Sean Taggy has been a part of over $230 million in real estate transactions. And then Tim on the end there has been an investor in over 2,000 units. This is just a sampling of some of the lead GPs in this deal. Brent and I are looking for sponsors who have significant experience, especially sponsors who have gone, round trip, and they've had gone from buying to selling. And this has sponsors on here that represent that, which is great. Sam also has been an investor, or is an investor, in two other properties in the Nashville area. So that's significant for us. He'll talk a bit about this, but the property management company that he's used and his partners have used for those other deals is the same property management company we're using on this deal. And they've been highly successful in working with them already. So really strong leadership team that we're excited about. And then the deal itself, like I said, Sam will be getting more into this, but finding deals in the current market, as many of you know, the deal flow has slowed down this past year as we've been kind of waiting to see. But this deal, it ticks all the boxes of what I've been looking for. It has a fixed interest rate for 7 years. It has interest only for 4 of those 7 years. It has an IRR that could be as high as 20%. It is a strong value add where its current rents are already below market value, below its comparables. We're going to get into a lot of that, and Brent and I will kind of chime in at different places as Sam walks us through that. But we did want to give you at least a little bit of an intro as to why we're excited about this deal. And before I jump it over or send it over to you, Sam, I saw you skipped over the slide that we do always say at the beginning, which is that none of us here are CPAs. We're not attorneys. All investments come with their own risk. We're investors. You're an investor. You can lose your money on this deal like you could on any other deal. We do our hard work, but we do want to put that disclaimer out in front with that. So with no further ado, Sam, let me throw the ball into your side of the court and let you run, and we will interrupt you, hopefully politely, at different times along the way.
Yeah, perfect. Rick, Brent, thank you. Can you guys hear me okay?
Oh, yeah.
Yeah, you bet.
Wonderful. Well, great to be with you all tonight. Very excited to have Rick and Brent on this deal with us. It's fantastic as well that Brent being local to Nashville and our entire portfolio being focused on Nashville, that we're very excited to have local investors in this deal as well. As Rick mentioned, I'll share a little bit more about them as well, but our property management group is local to Nashville themselves, and they're large investors personally too. They've invested millions with us in our deals and have brought their family and friends into. So we love having local Nashville investors in our deal as well. So great to be with you all tonight. As Rick mentioned, my name is Sam Frower. I'm the managing partner of Compass Capital alongside my partner, Michael Whiteley. Prior to founding Compass Capital about 3 years ago, I worked at a REIT in Utah, a couple $1 billion asset under management REIT, where I was involved in about $500 million worth of transactions, all in the multifamily value add space. So a lot of experience in and around multifamily value add prior to going and creating Compass. As Rick mentioned, our whole portfolio is focused on the Nashville area. We've got about 50 million of assets under management. Our current properties are performing extremely well. And this is the first deal that that we're talking in December. This is the first deal that we've done this year. We're very conservative. We're very careful in the deals that we choose to invest in. And unless we very conservatively believe that there is a lot of upside and a strong investment, we're passing on 99% of what we see. And Easton checked all our boxes as it did Rick's and Brent's. And so excited to share a little bit more about it with you tonight. At a high level, I'm not looking to jump in and dive into every slide and take an hour of your all's time. We'll love to try to keep it more succinct as much as possible. But that being said, Rick and Brent, please interrupt to me as you have any questions, or if anyone, you all have access to the chat, which Rick and Brent can be looking at as well. And if you have any questions as we go, please let us know. But with all that said, excited to share with you guys tonight a little bit about Easton Apartments. This is a 205 unit value add play in Nashville, Tennessee. I'll jump to the returns shortly. But before I do, actually, we'll go ahead and start. Yeah, here we go. And let me minimize this on my screen so I can see it all. Perfect. So this is a 206 unit value add. I'd call it C class now, though our goal will be to turn it into a B class workforce housing type asset. And this is located in Madison, Madison, Tennessee, about 10 minutes north of Nashville. Part of why we really like this deal, and again, we'll dive into the Nashville market in general at a high level shortly here, but we love this is one of the areas pretty close to Nashville that has not been heavily invested in yet. Much of more the Brentwood, the Franklin's, more south of Nashville, Hermitage, those areas have had a lot more money being poured into them in earlier times of the Nashville boom. This Madison area is now having a lot of money be poured into it, which we get really excited about, right? This is nothing that we plan for in our underwriting. We say, hey, this deal needs to work in middle of nowhere, Arkansas or Alabama, and has to make sense with very conservative numbers. But we get excited that if we're in the path of growth, that there's a lot of potential upside. And so this is a very classic value add play where we'll be going in, and a number of the units have been renovated already, which I'll share a little bit about in a bit. But we'll be going in and renovating the remainder of the units as well as the exterior. So we'll jump into all of that at a high level. Before we do, I like to begin every presentation with what this means to you as the investor, right? That why should you care about this building in Nashville, or be taking this time tonight to be looking at what you could be investing in. At a very high level, what is important for us to kind of check the box for an investment to make sense is that for our limited partners, which would be all you here tonight, that you have the opportunity, right? There's risk in everything, but as we look at over a 5-year hold, that we're feeling confident with our underwriting that you'll be able to 2x your investment over that time. So let's say you invest $100,000 initially, that's turning into $200,000. That you're also getting cash on cash throughout the course of the project. So you can see here, projected average cash on cash is 7 to 9% every single year. Meaning again, right, if you invested $100,000 that each year, you'd be getting around that amount. Though again, right, begins lower in current years, which I'll show shortly here as we're actually executing on the value add play, and then grows from there. As mentioned, we're looking at a 5-year investment term. We obviously have flexibility to sell sooner or later. Our goal always is to maximize investors' returns. And so if we execute quickly and the market's great, there's a good chance that 5 years could be less. but we like to have that buffer of time frame. And a projected IRR, which is kind of just a fancy way of saying ARR, is 16 to 19%. So again, over the course of the investment, 2xing your money and having cash on cash throughout the course of the investment. And just at a little bit more of a high level of what that looks like, you can see here that COC return on the left-hand side. That means your cash on cash return. And you can see that it grows from year 1 up until year 5. And again, that is because that we are actually enacting on the value add play in the first couple of years, where we're renovating the units, where we're maximizing rents. And so rents are starting lower and then growing from there. But part of why we really love this value add space is that we're buying a building that's already 95% plus occupied and cash flowing, that you're not having the risk of development or the lack of cash flow of development of hoping that something that you're creating and building is going to work out, but that we're creating something that already, or we're buying something that already exists, is already cash flowing, with a lot of upside due to the mismanagement and the renovation that we'll be able to jump into for the property. So
Sam, I'm going to jump
with
in.
all that,
I'm going to
go
jump
ahead.
in.
I was going to ask any questions.
I'm going to jump in with a question for you on the overall IRR return. If one of our investors had looked at the underwriting spreadsheet, it would say a projected IRR of 20%. Here we're saying 15 to 19%. Can you just talk about our philosophy of what numbers we talk about and how we promote those and how we land on those numbers?
Yeah, sure. So at the end of the day, being conservative, at least for us, is the name of the game, and it's why we're very careful in the deals we do. And as mentioned, this is the first deal that we've done all year. That we in general will say, hey, this has to underwrite to a 15 IRR for the investor for us to be interested in the deal. This one, as Rick mentioned, we're actually underwriting at about over a 20% IRR. Which is honestly phenomenal returns. You typically do not see 20% plus IRRs in the value add space. It's the price of the building will usually go higher, and again, we've got a great relationship with the seller, and we're able to get. We were actually one of the not the highest offer for this property, but because of our relationship with the broker and then the seller, we were able to get a significant price reduction. But all of that to say, we're projecting this 16 to 19 IRR because our goal is always going to be to under promise and over deliver. And so, yes, even with our existing conservative underwriting, as Rick brought up, we're looking at over a 20% IRR, but we'd rather knock your socks off with that actually happening as opposed to projecting it day one. As you've brought it up, I guess I can give an example of that too. That, for example, our first property that we bought in Nashville in 2021, a 124 unit building, we bought that at $14 million, and same thing, right, with a projected 5-year hold and 2x return. Less than 2 years later, we refinanced that building into a fixed rate and longer term debt, and it appraised at $25 million. So that's an example. Again, if we were to sell today, we'd probably 3x our investors' money in 2 years as opposed to 2x in 5. So that's, again, right, not every deal is going to turn into a home run like that, but that's what we're looking for, and saying, we can't control everything, but there's a lot we can control. And so we're very cautious and conservative as we put the numbers out that we do, feeling fairly confident. Again, no one has a crystal ball, but that fairly confident that we can achieve them. Does that make sense?
Great. Thank you.
Good. Thanks.
Awesome. Well, at a high level, before I dive into the building, I think it's important to talk about why we love Nashville. Again, you'll all have access. Brent and Rick can send you these slides after the presentation, and you'll have the recording. So I'm not going to spend too much time on each slide. But essentially, Nashville is one of the most booming areas in the entire country. For the 3rd year in a row by PwC and the Urban Land Institute, it's been named the #1 place for real estate investing prospects in the country, which is crazy because that's like the real estate investing study that goes on every year, and no city has ever been #1 3 years in a row. It just shows to the boom that Nashville is. One of my favorite things, I don't have it on the slides, but I'll bring it up because I love it, is that Nashville, not only is it, very business friendly, landlord friendly, you're seeing a huge population boom, economy boom, and it's still a relatively cheap place to live compared to, some of the LAs, the New Yorks, the Chicagos. But I love that this city is actively wanting to grow. as the Urban Land Institute and PwC called it, they called it a supernova of growth. And a big part of that too is that the city itself and on the political side is that they and Davidson County, the county it resides, they want this growth. That you probably all are familiar with the NFL and the Tennessee Titans, that they are rebuilding Nissan Stadium, the Tennessee Titans Stadium. Again, it's a fine stadium and is functioning well, but they want it to be the hippest, most state-of-the-art stadium. And they're going to be building an over $2 billion new football stadium to replace the existing one. And with that being said, the city of Nashville is going to be paying over $1 billion for that, which is more than any city has ever paid for an NFL stadium ever. Right. But their goal and thought is this isn't only for football, but we want to be one of the music and entertainment and pop culture centers of the world. And so which again, right, says a lot about what this city is and what they think it can become. Any of you who live in Nashville, or if you go visit, I mean, it's just kind of cranes as far as the eye can see. There's so much growth and development going on. And so we really like that if we're going to invest anywhere, that we are investing somewhere that has the potential for, again, that it's got to work as if it was in middle of nowhere, Arkansas. But if we're buying somewhere that is in a high growth area, that like that first deal I mentioned, that we bought at 14 million and it appraised at 25 million, that we have opportunities for things like that to happen. Any questions there, Rick or Brent, or any other comments you want to make?
All I can say is amen to the Nashville. I've been here a long time, since the early 90s, and just have watched the tremendous growth. Daniel Baker, who's on as well, lives here, and it's just amazing. Like Sam was saying, there are cranes everywhere downtown, and I'm watching the stadium. Obviously, all the approvals have happened, and the East Bank is just getting ready to explode with Oracle. And as we get deeper into the slides, you'll see some of that, obviously, growth on the East Bank and then out towards Madison. So super excited about this area.
I'll add
Yep.
one thing. I'll add one thing. This specific apartment is in an area called Madison, which, as they were saying, is just northeast of Nashville. And in my own due diligence, just digging through Google articles, found an article from the Tennessean, the newspaper there from this year, talking about how rents in Madison are likely going to go up because they're below market rents right now in that area. So that was kind of interesting to me. The very area that this project is in, the local newspaper is saying rents are going to probably rise as well.
Yep. Well, I'll share a little bit more about Madison specifically shortly, but yes to all of those points. And right, you can see on the right hand side, Oracle, one of the biggest tech companies in the world, that less than 10 minutes from this property. They're already mid-building a 65-acre campus, over $1 billion investment, 8,500 employees, 21,000 construction jobs. We actually have people living on site at Easton who are part of the construction here at Oracle. And so and Amazon also has a big hub coming in, a variety of other tech companies coming in as well. Just a lot to like about Nashville. So I'll just quickly run through these and say you can look at your own time. But a variety, right? Wall Street Journal, Stessa, Money Geek saying this is the #1 place for economic growth, for job seekers, for economic strength. The unemployment level is at all-time lows compared to the national average. There is development, transportation, et cetera, just going on everywhere. One of the things that we also really like in a market is that it's not like a one-trick pony, that let's say one industry goes down, just as things always cycle, that then everyone in that city, right? Like Vegas could be like an example, right? Everyone's a majority of the people of the entertainment industry. If that goes down, that's going to dramatically affect how you're able to charge in rents or how you're able to run your business. We love that Nashville in general, you can see, very diverse in the types of jobs that exist, that even as these different industries cycle up and down, that we have a diverse workforce and demographic living at the property that is able to outride any specific industry that is dealing with volatility. Again, right, just diving into some of the top companies in Nashville. I'll let you as investors dive into this at your own leisure. Same thing here, just showing why we love Nashville, economic drivers going on, how it compares to other cities. There's just a lot to love about Nashville. And to Rick's point of why we like this Madison, this Northeast Nashville location, is that this Madison in general has typically been one of the less desirable areas close to Nashville. But similar to what has happened is Rick lives in Austin, Texas, and can probably attest to this, is that what I call like the Austin effect is that as Austin has just boomed in this circular effect, that everything around it in an expanding circle just starts to be developed. And so that has happened and is starting to happen all around Nashville. And all of the, I guess you could say, quote unquote, nicer areas around Nashville that are within 10, 15 minutes of downtown have already had a ton of development going into them. And Madison is kind of that last place where someone's like, hey, I still want to get in on the Nashville boom, but I can't go to these Brentwoods, these Franklins where already, billions of dollars have been poured in, that Madison's kind of that next place. And so within where our property sits, I want to say that there's about $2 billion worth of mixed use development going on around our property. And so we get really excited about that because our model doesn't plan, or how we're projecting this deal doesn't plan for any of this growth. We're saying, hey, this is just still your steady Eddie workforce housing, not big rent jumps happening year over year. It'll just kind of continue to perform as it does as we execute our value add. But there's a really good chance that with all this going on, that it gets the tailwind or the windfall of all this growth and development going on around it, which can dramatically increase the median income in these areas, which dramatically, of course, then can increase the type of tenant and rent. And so as mentioned, right, here's just an example: Madison Station, Riverside, Landings, Newhoff. Here's all of these all of these mixed use developments that are either approved or already starting to be underway, that are going to be going on around the property. And specifically, you can see Easton on that top left-hand corner, this Madison Station, which has been approved for development. That's this is less, it's like a half mile or a quarter mile from the property, but a $600 million development that right now it's kind of just this like old retail shopping center that they're going to completely change and transition this into a beautiful mixed use development area, as you can see on the right hand side. So all of these things we get excited about, not because we're like an A-class type housing asset or property, but that as all this goes in around us, again, we're going to be putting in a lot of money into the property itself to make it look and feel nice, but we're not going to be competing with any of this A-class type stuff. We're going to be far below any of their rents, different tenant demographic that we're going to be aiming towards. But all of this just in general boosts the area, which allows us to be able to hopefully increase rents as we continue to go a lot more than we initially project. And then just one last slide too on Oracle of just everything that's going on there. So a lot to really love about the Nashville market and specifically the Madison area that we're going to be investing in. Any other comments you guys want to make, Brent and Rick, on the area before I jump into Easton itself?
Not by me.
Nope, thank you.
Awesome. Let's talk a little bit about the property itself. So just at a high level, as we talked about, professional management, that we are going to be using the same property management group that we have used for our other properties. A few reasons we like them. Their name is Volunteer Properties. They're, in our world, what we'd call mom and pop, in that they manage about 5,000 to 6,000 units, which is still a lot, but it's not like some of the like 50,000 units that some of the really large property managers own. But that allows us, one, that's enough units that we know they know what they're doing. But two, that we have a really strong relationship with the president and owner. The president comes from a family that owns about 1,000 units in Nashville as well. And so they're their own, call it family office, but they've never done this with anyone else that they manage properties for, but they have invested millions of dollars in our existing properties alongside us. Just they love how we do business, the properties that we find, and the overall business plans that we have. So it's great to see that our managers have some skin in the game. And I'd say equally as important, or probably more important, is as we've now worked with them for years, that they actually do a good job. That two sides of that, both on the property management side, the day in and day out of leasing and maintenance, and taking care of the asset, they do a great job of, but also they have a GC, a general construction arm. And so they have run the value add plays that are other assets that are honestly more heavy value add than this property is. So we feel very confident that they will be able to execute not only the property management side, but the general construction side alongside it as we move along. So we like the property management team. Again, that's Volunteer Properties if you want to look into them a little bit more. And then as mentioned, right, what we're looking to do, be putting about $2.5 million into the property. We'll dive into that a little bit more shortly. And then at a high level, right, increase net operating income and reduce expenses. That is, we're looking to sell this asset in 3 to 5 years. That driving that income up is the name of the game. And if you're able to, again, right, very simple math, kind of what gets exciting about real estate, like let's say there's something called cap rates, which is what usually will tell you how much a building can be worth compared to how much money it's making. And in a very simple example, more or less in the city of Nashville and around it, that for every dollar of profit you can increase the building, that building will that asset will then sell for about $20 more. And so it gets really exciting that it's like, hey, if you can increase the income of a property by $1,000, that's going to be $20,000 worth of value as you sell the asset. So we get really excited about kind of just the scale of, as we're able to make sometimes even minor changes in the building can have really significant impacts on the bottom line and the money that we all make as investors. And so as we look at how we're going to finance this deal, that we're, again, as we've talked about, just being conservative at a high level, this is a very volatile time. And so we're all about doing everything we can to control as much as possible and to ensure that we are protecting our initial investment. And so a few things that we're doing there, we're using Fannie Mae, what's called agency debt. You've probably all heard of Freddie Mac, Fannie Mae, but they're the two really massive lenders in the space. And where a lot of people will use like bridge loans and be very highly leveraged to maximize the returns, but they're also increasing a lot of the risk that goes alongside it. We're having relatively low leverage, will be about 66% loan to value in terms of the debt that we're putting on, but we're also putting on a fixed rate that you're seeing a lot of people in the real estate space had in the past few years done these variable rate loans that, as you all know, interest rates have gone up significantly. And they're all now, they're feeling the pressure and feeling the heat as their interest rates, which they were not planning on, went up significantly, which is eating into all of their cash flow. And in some cases, right, they're now underwater. So we're making sure that that does not happen. We're getting a fixed interest rate. It's over a 7-year loan, even though it amortizes over 30 years, and 4 years of that will be interest only payments. And so again, we like that from a conservative perspective, that we will not have to worry about the volatility of the market, no matter where interest rates go. That we feel very comfortable given the cash flow of the property as exists and what we can do compared to where we will be needing to make payments. That we are in a very safe place.
I just want to jump in, Sam. I just want to make sure everyone understands just the significance of those financing terms and how strong they are. To be getting a rate that's just under 6%, to have it fixed for longer than the term that we're going to own it, to have it be interest only for 4 years. That right there is one of the reasons why my eyes lit up when I saw this. Many other things had to be in place, but if you want to know, if you're hearing at all about multifamily being in trouble in different sectors and such, or different areas of the country, it's because they signed up with bad terms, bad debt terms. These are very favorable terms for this kind of a deal. So wouldn't even be doing this if it weren't for that case. So just wanted to take a yellow highlighter kind of verbally and note that on as you're going through this.
Yep.
Thanks, Rick. Oh yeah, go ahead, Brent.
No, go ahead. I agree.
I was going to say, yeah, we view this as a huge deal, right? And you're seeing other operators and sponsors in the space that did not do this, and they're now kind of paying the price for it. At the end of the day, we want not only ourselves, but our investors to sleep well at night, to say, hey, we've got a lot of potential upside here, but regardless of what's going on in macro level market conditions, that we are locked in and safe, so to speak. And so to Rick's point, we won't even look at a deal right now unless it has this type of financing on it, just so that we can feel, understanding the volatility of the market, that we have that protection of the downside and of protecting our original investment. As we look at the sources and uses, again, won't dive into this too much. Feel free to follow up and ask any questions you'd like. But the purchase price is a little over $27 million, $27.2 million. A mix of that will go to not only, and I should say our total uses is about 31.5 million. And so with all that to be said, and again, we're still locking in as we close in coming weeks, the exact dollar amounts for all of these, but this is roughly how it will turn out. That will have a mix of operational capital, right, just to have extra money in the bank as needed. Capital improvements, that's where we were talking about, right, the money that will actually be going into the property, the closing costs involved with it as well for that total number. And then you can see on the bottom the sources of both where it's coming from, the debt financing and the equity investment. We'll probably end up a little bit closer to 12.5, 12.3 to 12.5 of equity compared to this 12.9 as we've been able to more dial in our numbers, but it'll all come in close to here. And so as far as what we're looking to do and the timeline that we're looking to do it is in the first 2 months, and I'll share more about the specific business plan shortly, but to complete the exterior upgrades
2 years
that we've discussed.
2 years, yeah.
Say that, oh, 2 years, yes, apologies.
That'd be pretty quick.
Yeah, over the first 2 years, thank you. Complete the exterior upgrades and add new amenities, continue to renovate. About 80% of this property has already been renovated, even though they've done a very poor job of managing it and bringing the rents up to what is market. That we will continue to renovate the remaining 36 or so units and continue to push the rents of those already renovated units. And then as we look into months 24 to 36, and honestly 36 and beyond, we'll look to stabilize the property by then, maximize the rents through having executed our value add play. This is nothing that we've included in our underwriting or our model of like all the returns that we've shared with you. Again, just to under promise and over deliver, but potentially, and our plan will be depending on where the market is and how the building is doing between, you know, ends of year 2 to year 3, that we'd look to either put a supplemental loan or refinance the property itself. With the goal being to return the majority of the equity, your equity that you've invested back to you, call it between 50 to 60%. That again is just your money back into your pocket to do with as you will, even though you're still fully in the deal in terms of the cash flow and the profits that we'll receive when we sell. So we don't have any of that pitched in our potential returns area that we've discussed, but that definitely is part of the plan, just another place that we'll be looking to drive value for investors. And then, of course, we're going to look to continue to focus on cash flow and then look at that sale in years 3 to 5. As far as how we'll actually do that, as mentioned, a big piece is going to be renovating the remaining units. That about 170 of these units have already been renovated by the seller. Now, this seller that we're buying this from is a big fund that owns thousands of units all around the country, but almost nothing in Nashville. And you can tell that they've done a good job of making this property look nice, but then it's like they forgot how to manage. And Brent and Rick have seen the property and walked around. We'll get to some pictures shortly, and they can attest to it too. But that's where we kind of get excited that we had some extra money to say, hey, they've renovated 80% of these units, but they're probably not in very good shape. They actually were in really good shape. We're not going to need to do too much to these units other than spruce them up and add maybe a little bit of like a premium type package. But that won't cost more than $1,000 to $2,000 as we turn those units. And then for the remaining 36 units that have not been renovated, we'll be going in and actually be putting in about $11,000 to $12,000. And you can see here in a picture of this is what it will look like. Essentially, we'll be putting in black appliances, vinyl flooring. We'll be updating the cabinet boxes if we need to, the fronts, the hardware, right, the little metal knobs. We'll be updating the lights, the bathroom area, the tubs, all of that. We're just going to be renovating it to give it a much nicer look and feel than it currently does. And then on the outside, this is where we also get really excited, is that, or I guess I'll pause here for a moment just to let Rick and Brent say, like, as you've driven and seen this asset, someone I jokingly / not jokingly said, this is what I see as sexy, this kind of slightly rundown property. And they're like, why do you view this as sexy? I'm like, because there is so much untapped potential here. And I guess I can let you guys talk to your initial thoughts, and I can share a little bit about what we're going to be doing.
Well, I'll chime in real quick. No, I've been a few times and have had the opportunity to walk through several units and that were renovated and were very nice. And yeah, there were minor things that we want to do to them. But I think that was a huge plus for me to get on board, was that most of the value add side of this is the exterior, is to make the property really pop on the exterior, updating the landscaping, the painting, the pool area, pool furniture, all those extra things, dog park, the play area. Just to, as we were walking around, just really people start to feel more ownership and pride in where they live when you add these things, and it just adds that personal touch. So I'm really excited about these upgrades on the exterior to where they have more pride of ownership and where they live. So that was a huge perk for me, and not the heavy value add of every internal unit. So I'm excited about that.
Sam, I'll hold my comments until after you show the comparable prices, because I want to
Get
tie
your
it to
pictures.
that.
Perfect. Yeah, that sounds good, Rick. And so, yeah, to that point, right, what we really like about this is, to Brent's point, it's not heavy value add. It's fairly easy stuff that we get excited that with the way that their units, the ones that are already renovated, already look like they're getting and starting to get the rents that we're looking to achieve when we take over the property. And so it's like, hey, they're already proving out our business model that this type of unit can get the type of rent that we're looking for to get the returns that we're sharing with you all. And our goal and plan is to go absolutely above and beyond that for two reasons. One, right, as we take care of this property and make it really pop and change the curb appeal, that may allow us to increase rents even further. And two, right, any of you that are in business know that that turnover is going to be your biggest expense. It's the biggest expense of almost any business, and it's no different in multifamily. That people leaving is always going to be the biggest, the number one expense you face. And so as we are able to change the culture of this asset, which we'll be doing not only with our property management group and starting to have, right, like quarterly events with the tenant base, inviting them to be interacting with each other, just changing how we as the property management group are interacting with these tenants. We're also going to be totally changing the look and feel of the property. As you can see, right, this is a big 205 unit property, and it's crazy that some of this isn't already done with the families that live there, but we're going to be adding a playground, a dog park. It's super dark and kind of dingy at night. We're going to add a ton of lighting and security cameras just so people feel safe. The pool, this is a decent picture right here, but we're going to be, these old mustard yellow pool chairs. We're going to completely be changing and updating the look and feel of the pool area, adding a grilling station out there with a pergola. We're going to be painting the exteriors of the building, both the siding and most likely the brick. We're going to be adding a bunch of signage and landscaping. Rick will show you a picture shortly of, it's amazing what landscaping, which is not that expensive, can do to like make or break how a property looks. So we're going to be doing all these different things, again, just to give it a totally different look and feel as we really change the culture that currently exists at this property. And so again, won't jump into this too much, but at a high level, here's like our capital improvement breakdown of that $2 million that I shared with you, and where each of those dollars are going as we're looking to renovate the property. A strong amount primarily into the renovation of the units themselves. Few other items just as we go into the property details itself. You can see here in the non-white area that this is the Easton layout, that you go in kind of on the left hand side of that arrow, and that you drive down a hill into, you can see apartment buildings all along the right hand side, which then kind of curves into a U shape to more buildings up and over into the left hand side. As far as unit mix, we also really like this too, that predominantly in multifamily investing, that most of your tenant base is going in most areas is always going to be 1 bedroom and 2 bedroom type tenants. That's going to be what they're looking to live in. And the vast majority of this property, over 90% of it, is either 2 or 1 bedrooms. And so as you can see here, and again, won't jump too much into this, but would invite you to follow up and take a look yourself as you look at the presentation. But you can see here's our average rent, and I'll jump into why that matters as the big, value add play, and what a lot of this comes down to is, what are other properties in our area looking like, and can we achieve what they are achieving? And so as we look at these properties that were built in similar years to us, that are within close proximity to us, that more or less have the same look and feel, understanding, hey, if we match what they're doing or do even better than what they are doing, there's a very strong correlation with the ability then to get the same rents that they're achieving. And so we see, for example, right here, these competitors, Breckenridge, Hickory, Ascent. You could look these up online. And you can see the rent that they're getting, the average rent on the right-hand side compared to what Easton is getting, and they're a couple $100s below, right? This is your classic value add play to say as we put the money into the property and make it look like these competitors, or in some situations better than these competitors, we can definitely be expecting to be getting the same rents that they are. And that's where we, right, as investors really make our money. And so these slides go through both through the 1-bedroom, the 2-bedroom, and again, we only have 10 of them. Oh, and I didn't even include it on the slide because we only have 10 of them, but 3 bedrooms that were significantly below. You can see for 2 bedrooms as well, less than $1,300 compared to the $1,500 plus for the competitors in the area. And so our goal will be to manage correctly, renovate both the interiors and exteriors, and be able to get these same rents that other properties in the area are getting.
So Sam, this is where I'd love to jump in for a second, if you don't mind. Go first to the 1-bedroom that you just showed, and then the 2, and then, so I want you guys to note these numbers. So see that line that says Hickory, and on the far right, it has a 1,255 as the average for 1-bedrooms. Easton is our apartment, so the average is just over $1,000. So about a $200 difference per month, which is a lot of value. Okay, then go to the next slide. For 2 bedrooms, same thing. Hickory is at $1,568. We're at $1,264. So about a $300 value on the 2 bedrooms. So when Brent and I walked, the photos I want to show you are from 2 days ago. Among others, we walked ours, Easton, and Hickory. Now, I want you to pretend that you are going on these sites, looking to see if you want to rent either of these places. You would very likely go to both of these. Not a chance you'd be saying, I want to look at the garbage cans. But just look on Easton on the left, there's the garbage dumpster sitting in the middle of the parking lot.
Yeah.
Hickory has a nice fence and it's newly painted. It just makes Easton look sloppy and poorly managed. Very small fix, but something that you can do. Go to the next slide. Easton is on the left. Look at the landscaping there. Again, this is December. You kind of expect things to look dead, but look at Hickory, same day. This is 2 days ago. It's nicely manicured. It looks green. They've done a nice job with the landscaping. One of the things I've learned in all of my investing is how much curb appeal matters. Simple little fixes like this. You want to live in a place where that looks nice. This is inexpensive, the kind of changes that you can make. Now, go to the 3rd slide. We talked about painting. Again, this photo was taken 2 days ago. I'm walking at Easton, and I look at the siding. This is going into one of the hallways where the apartments are. That's the siding right now. Hickory on the right is one of our competitors that has that painted brick. They don't even look that great. But if you were walking in and going, I want to be a tenant here, and we're comparing these two, it's no mystery why Hickory is getting $200 or $300 a month more in rent for an apartment that was built around the same time frame and in the same area. So I looked at this, I was like, okay, this is for real. Like I've flipped almost 40 houses. It's the same concept where you're looking at, I want to see what the distressed house looks like, and I want to see what comparable houses in the same area look like. Can I make mine look like theirs or better and sell it for that same amount? That's what this is doing here. And it's one of the reasons why I wanted to walk it myself to see if it's for real. And this leapt out at me. Like, this is real. We can make some of these changes that, it might be $100 in cost, but $1,000 in value. Just the kinds of things you can do when you just improve curb appeal. People want beauty. They want to be in a place that looks nice. So anyway, I'll turn it back over to you, Sam, but those are just a few of the photos, just simple things that we saw that got our attention to go, this really is a value add play where we think we can improve it and increase the net operating income.
Perfect. Yeah, love it, Rick. And to that point, right? Like as you yourself know, right? Like wanting to live, you see this dirty wall on the left-hand side versus the right-hand side. It's at least a little bit better, right? We're going to make it much nicer than that as well with painting and power washing and everything else. But by doing something, even a matter of weeks, right? We'll be immediately for this like exterior type work, be going in and making these changes. That is the leasing season kind of goes full blown in Nashville, which is in the spring. That we've got time in these winter months to really overhaul the complete look and feel on the outside to as Rick was just saying, really change the curb appeal, which that alone can have a massive driver, not only on the rents, but just the culture of the property. You feel different when you can tell that where you live is being taken care of. So all that to say, I won't spend too much time on the financial side. I would say you feel free to dive in and take a look. This is just our background supporting numbers as we go into later years of supporting. Here's why we believe that we can achieve the returns, the cash flow, the net operating income that we can. And so I invite you to take a look at this and let us know if you have any questions. But just know we've been doing this for years. We've been doing it with our other properties, which have been running well, and that we're very dialed in. That no one has a crystal ball, and to an extent, all of this right is projecting what's going to happen in the future. But by doing so very conservatively and with very conservative rent growth and sale numbers, we can say pretty confidently that we know that this is a good investment. And same thing here with this pro forma assumption tab. Would invite you to please follow up if you have any questions, but diving in both on the income side as well as the expense side. Like here's all of these different places of where we're getting money in and also where money is going out, and how we're making these assumptions based off of what we have been doing for years at our other properties, and what as we're working hand in hand with our property management group, which has thousands and thousands of units. They own a property literally less than half mile away that's also a similar vintage, and feel very confident that they can run this property at the level which we've described today. That all of that goes into the assumptions that we've made. So that's a little bit about Easton Apartments. Again, I don't know, Brent or Rick, if there are any questions that we've had in the chat as we've gone through. Hopefully we've been able to answer most of them as we've gone just very quickly. As far as some FAQs, as far as investor requirements, you must be an accredited investor, which means that you have a net worth of $1 million or that you're earning over $200,000 a year. That's something that you would need to share with us either through a letter from your CPA or going to a website like Verify Investor to verify in order to invest. The minimum investment amount is $100,000. If you're looking to invest from an IRA, you absolutely can. Sometimes they'll have specific questions. Your IRA will, in order to invest. We can answer all of those and help you if that's the case. As far as time horizon for this, we're looking to close this month, and we're already nearing being, or I'd say close to being full. And so please move quickly. We're very excited to have Brent and Rick and all of you have the potential to invest with us. So please sign up quickly as we expect this to go fast. And as far as how profits will be distributed to our investors, we have what's called a 70-30 split with an 8 pref. And so what that means is that 70% of the profits will go to the investors and 30% will go to us as the general partners. But that's only after you get what's called an 8% preferred return. So it means that you have to be getting an 8% return every single year. Let's say you invest $100,000, that you have to be getting $8,000 in that first year, or we don't share any profits. That it's only after you get an average or accruing 8% return every single year before we share in any of the profits as us as the operator or the sponsor. And so that is obviously motivating us to ensure that we really believe this is an opportunity that can hit these returns, because we have to give you that 8% return or we don't walk away. We walk away with very little money. And so as part of that as well, as you may have seen, like in year 1, year 2, the cash flow may be lower than that it will accrue. Like let's say we have a 6% cash return in year 1, that then we would need to get a total of that, we were 2% off. So that 2% plus the 8%, we need to get 10% in year 2 before we could start taking any of the profits on our end. So every year we're having to make sure that you're averaging out at least that 8% before we share in profits.
Sam, there's a question.
Yeah.
What asset management fees are on the project?
Yep, good question. You can see here at the bottom, we like to keep it simple. So we do it a little different than most groups who add a ton of different items, but we have a one-time upfront 3% acquisition fee. We then have a 2% asset management fee where we just take 2% of the revenue of the property, right? That's basically just for like software, travel expenses. That's no more than a couple $1,000s a month. And then a 5% construction fee, which is 5% of the total construction cost, which we use to run the construction management. We don't have any sort of refinance fee or disposition fee, or adding anything else along the way. Or you'll see a lot of other operators as well, right? Like I mentioned, the 70-30 split that many groups will say, hey, if we get you a 15% return, that's phenomenal. So we deserve more of the profit. And they'll say now it's a 50-50 split instead of 70-30, that we keep it a really advantageous setup to the investor, that we could be hitting a 20-25% return, and we're not going to skew more of the returns in our favor. And so that's something that, again, our goal is, as we work with you all as our investors, that we're able to roll deal after deal together, feeling confident that we have your best interest in mind, that is, as you do well, that we do well, and that everyone wins.
See any other questions? Not seeing any.
Perfect.
Yeah.
Awesome. Well, feel free to follow up with us at the end. And again, Brent and Rick will be able to share this deck with you. But you'll be able to, if they share this deck, you can click on that here link, and you'll be able to sign up now. It will take you to the portfolio page where you can sign up, and we'll give you more details as far as signing up, signing the PPM, the big 60-page legal doc saying we promise we're going to do what we're saying with your money, and here's what you're signing up as the investor, and also where you'll be able to wire funds. And so, as mentioned, we're looking to close relatively soon. Our goal is the 15th. Definitely, if it goes any farther past that, before the end of the year, we're looking to get funds in quickly as we look to close. And I'll just end by saying, this is, of all the deals we've done, this is the one, especially with the purchase price that we're getting this, and the price per unit. It's about $132,000 a unit. That is just a phenomenal price in Nashville, that we get so excited, even outside the value add play, that we were able to buy this building at this price. It's far lower than almost anything we've seen in the years that we've been investing in Nashville, just as the nature of where the market currently is, and this seller who needed to sell. So we love the purchase price. We think it's a very easy value add play to drive cash flow. And we think it's overall a very simple and strong investment. So we're excited for the potential to have you alongside us.
Hey, Sam, a question just came in, and I thought of one other comment. But the question reads, I think I saw it briefly, but what decrease in occupancy do you expect after renovations and rent increases?
Yeah, good question. And I just stopped sharing my screen, but I'll answer it quickly. That we have what's called economic vacancy, and to say while we're renovating those units, obviously that there's going to be additional vacancy while we run the value add play. This one's really nice in that we don't expect it to jump up too high, because 80% are already renovated. But where we would say that we expect to stabilize in vacancy at around, call it like 6 to 7%, that for those years while we're renovating, we're bumping that up to anywhere between 9 to right at the beginning, upwards of 14%, to say, hey, here's the cash flow is going to suffer because of this, as we're actually executing our value add play. And that's, again, why some of the cash flow is lower. But then once we stabilize the property, then that vacancy dips back down into normal levels.
And I don't know if you're seeing the chat, but we're having a couple others come in. For those units that have been renovated, what rent increases have been achieved already?
Yep, that's why we get excited, is you can look at the rent roll, and again, they've kind of mismanaged this thing, and so you can see that there's a number of units that they've like renovated that are getting the same rents as their non-renovated units, which is just like the worst thing you can do in a value add play. But you're seeing that they've started to get their act together going into this year, and again, they didn't necessarily want to sell, but the seller is starting their third fund and needed to sell a deal from their second fund to show value to their investors. And this was one that made sense for them to execute on. But as they've started to get the rents that they should be for the units that have already been renovated, they're the exact rents that we're talking about tonight. That they're getting the rents that the competitors are getting, that are about $200 to $300 more than what the average in-place rent is. That's why we really like this play, is they're already achieving the rents in some of these renovated units that we're looking to get. So we're not in any way trying to reinvent the wheel. It's just doing what they're doing a lot better.
And that's, I was just going to comment that the question was going to come up, I'm sure, and you just answered that about why would the current owners be selling? But obviously it's a fund play, and they're having to.
Yeah, and they bought this 5 years ago for $17 million. So for them, again, they didn't do a fantastic job of maximizing this property, but they bought it a great time, and they're selling it for $10 million more than they bought it, and they're going to be walking away with good returns.
Can you make a comment on the tax advantage if we can get this closed before the end of the year?
Yep. Other big piece of that as well, right, is the cost segregation study that we'll be running once we close the property. And so the way that works, and it's going down, it was 100% last year. It's now 80% bonus depreciation this year, and then drops down to 60 next year. So it's why we're making the push to close the building this month. But essentially what that means for you as the investor is, let's say you invest $100,000. That we are going to be running what's called a cost segregation study, which vastly accelerates the depreciation. And so more or less, right, this is what's been quoted to us by a company that we've used in the past, that for every $100,000 you invest, that in that year one, K1, the tax document that we send you, that you'll be showing $45,000 of losses on your investment. And so I would say, right, talk to your CPA of where the benefits of that, what that could mean for you and your own investment portfolio. But that will be showing for every $100,000 invested, $45,000 of losses on your tax documents.
That's year one, right?
Year one, correct.
Yeah.
It also means it's going to take some time to get that done. So I like to set people's expectations on when they would receive those K1s. It's pretty common in multifamily to have to file an extension to be able to get all that in. I suspect that will be true on this case as well, Sam. Is that right?
Potentially. We'll avoid it as much as possible, but I like you saying that to, again, under promise, over deliver. Last year we closed a building in November, and we're able to have everything wrapped up prior to March. But it's not uncommon, like you said, for these things to be pushed longer. And so it's again, right, if you have to file an extension, it in no way hurts you, but there's a chance that could happen. Yeah.
I just like to set expectations.
Set the stage. I like it.
Happens, so, okay. I think we've taken everyone's time well, and Sam, you've been very helpful. Brent, thank you. Thank you, everyone. Brent and I will, of course, be following up with each of you individually and giving you the links if you want to take a next step and answer any questions you might have. Sam has also made himself available for any one-on-one conversations and all that. So anyway, thanks, everybody. Appreciate your time.
Yeah, thank you so much for joining us. Thank you, Sam.
Thank you all. Yep, have a great evening. Thanks, everyone.
In touch. Thank you.